Good evening, ladies and gentlemen, and welcome to the third edition of the Rasameel Webinars. My name is Ali Leflay from the Client Relations Department at Rasameel, and I'm honored to be your host tonight. Since our last webinar in July, we've witnessed a short-lived correction in the market, followed by further growth. We saw countries and economies coming out from lockdowns, but are looking again at new restrictions due to the start of what seems to be the second wave of COVID-19. We also saw government offering further stimulus. For example, the EU launched their 750 billion euro solidarity fund, while the Trump administrations are putting down proposals for around $2 trillion of a further package. With all that happening simultaneously, investors needed to be cautiously navigating through these turbulent times, but also needed to keep an eye on opportunities that could arise out of these events. In fact, tonight's webinar is titled, "For every crisis, there lies an opportunity." Our speakers tonight are Mr. Robert Aspin, Head of Asset Management, Mr. Al-Dakhil, Head of Alternative Investments, and it's my pleasure to welcome our guest speaker, the Chief Executive Officer of Rasameel, Mr. Sameer Al-Gharaballi. Thank you, gentlemen, and welcome to this webinar. The plan is to go through 35 to 40 minutes questions that I've prepared, and then at the end we would like to have a 15 to 20 minutes Q&A to answer some of the questions by our dear guests. Now, our guests, you can post your questions on the Q&A icon. You can either find it at the bottom of your screen or at the top of your screen, depending on what device you're using. Let me start with you, Butalal. As a veteran of the investment sector and having witnessed several market crises over the years, what would be the main lessons that you have gained from these events?
Good evening, everybody, and welcome to our latest edition of our webinars. Thank you, Ali, and welcome on board. Throughout my career, I can tell you that I have come up with few, guidelines that will guide people into investing. The first thing is investing is a very important and very crucial, very integral part of growing your money and from keeping it from erosion by the inflation, and if you are a Sharia compliant, by zakat. So you have to make money every year on that money that beats those two in order for you to keep your money growing. Having said that, do not do it yourself. I mean, unless you are a professional. You should continue whatever you're doing and you're successful at, and give your money to people who are successful in managing the money. Do not do it yourself. Number three is the equities. Equities, the main grower of wealth over the years. And equities, when I say equities, I mean you have to be diversified in equity, diversified asset class, geographical. You have to be diversified. And then when you are in equity and you are diversified, you have to be a long-term investor. Do not try to market to time the market. For example, just a little example to explain. If my first international crash was in 1987, the crash of Monday 1987. And if you entered the market a day before, you paid invested, and in 1989 United Airlines crash, and 1990 Kuwait invasion crash, 1995 the Asia currencies, 1998 the Russian fixed income, 2002 the dot-coms, and then the meltdown in 2008, and then even now the COVID when it happens in March. And if you are still invested, you would have made 28.5% every year for the last 33 years, which is a really nice wealth grower. Real estate also, it's a very important part of the asset allocation model. It will bring you a nice income, especially when interest rates are low. It will give you a nice income. Private equity and venture capital, they have to be, but unfortunately these are very, very high minimal. So if you find a suitable vehicle to tap into this market, you really should, because it's the future. The future listed companies, it's the private equity venture capital now. And finally, you should always have a dry powder. You should always have cash on the side, because as you said, opportunities will pop up from now, from time to another. And if you have cash, you can really take advantage of. These, I think, what I will advise people who want to invest their wealth.
Thank you, Butalal. These are certainly valuable lessons that we need to be aware of. What about Europe? You yourself have experienced some of these events. What have you learned from them?
Thank you very much for the question, Ali, and great to be back doing another webinar. I think it's the third in our series this year. So my career goes back around 25 years. I joined JP Morgan back in 95. And the key finding, I guess, is that the markets move in boom-bust cycles. We've seen that, as Boutalal was indicating. He's seen a few more cycles than I have, but you get market tops and then a decline and so forth. And history basically continues to rhyme. So I think the key ingredients to be a good investor is, number one, you've got to have a process. You've got to decide what type of investor are you? Are you a momentum investor? Are you a value investor? And what tools are you going to use and methodologies are you going to use to basically manage your portfolio and make money within the markets? Number two, you've got to stick to your process. You can't change your process. You can't become a momentum investor and then a value investor depending on the cycle. You've got to stay true to your roots. Otherwise, you get whipsawed in the market. Probably third is manage your risk. It's no good focusing on the expected return without worrying about the risk. You've got to focus on managing the risk well, and then the return basically will be a fallout of that. Fourth would probably be you've got to stay invested. Boutalal was highlighting that as well. You've got to stay invested through the cycles. And what we do as valuation-orientated managers is we will reduce market exposure at market tops and then have the capital, the cash, as Boutalal was indicating, to buy at the market bottoms. And that's what we're trying to do as value investors. Momentum investors, on the other hand, would chase the market higher. And then be global. I've been global now for basically my entire career. And being global and focusing on companies and sectors globally gives you two things. It highlights the opportunities that may be coming, and number two, it highlights the risks that may be coming as well. So it's very important to keep your focus on the global markets. And a good example of that, for example, was when I was covering certain sectors of the market, banks and so forth. And I was also looking at the housing market in the US, which was obviously a core part of the financial markets and had a direct impact on the financial space as well.
You've mentioned the process, you've mentioned the strategy, Rob. Could you tell us a little bit more about the latest market situations and the performances of the different strategies that we're managing at Rasameel?
Sure, with pleasure. So hopefully on your screen now you see the strong performance track record. And basically what I've done here is I've highlighted a couple of the strategies that we run for clients. So global equities, disruptive technologies, and our model portfolio, which is balanced. And the very good news here is obviously the fact that we've outperformed. So this is data going back to the end of September. So you can see that, for example, year to date, the strategy, the DT strategy is up around 11% and the benchmark is actually down. Now, when I look at the data as of yesterday, the benchmark is pretty much flat for the year. So we track the MSCI Islamic benchmark, and that's pretty much flat. And we're up now around 15.3% for disruptive. And indeed in global, we're up now around 9%. So we're actually outperforming both the benchmark that we've got and also the S&P 500, which is what a lot of investors also look at. So performance is very good. What drove the performance is the process. So when we look back at the period in January, I was focusing on what was going on in China. I was focusing on the issue with COVID, and we actually as a team started to reduce exposure. And I think this came up in the prior webinars back in January and then also February. So we outperformed in the down market, and then we were able to add exposure in April, May, and actually even widen the return profiling with the outperformance over that time period. So we've been very happy with the process, and we're sticking with the process. And another key takeaway here is not only is the performance good, but also the risk metrics are good as well. So the standard deviation and the downside risk are both lower than the index, which is exactly what we'd like to see.
Thank you, Rob. Moving to you, Dakhil, how was the real estate environment during the summer, and how is it panning out till year end?
Hi, hello everyone, and thank you for having me again. Well, indeed, see, the summer usually is a slow period for real estate in general. However, we've seen even slower summer this year with a bit of spice from COVID-19. And generally speaking, across the board, global speaking, the number of transaction values is down by 30% compared year on year. So this summer is down by 30% compared to last year. Obviously, it differs from one sector to the other. The best performers are the logistics, and the alternatives, and logistics is down by 14%. So you could imagine what other sectors have done. Obviously, hospitality is hit pretty bad. it's down by more than 50%. But the good thing is that what we're seeing today is that there's more and more stock coming out in the market. We are seeing some good transactions happening around us, and we are keeping an eye on this. But different to other crises that happened before, you don't see people rushing and selling their assets. So you don't find any fire selling of properties. I believe this is one reason is that banks are more considerate with landlords or property owners, that they give them more leeways. They understand the situation. They are just waiting for them because they understand that this effect eventually will go away, will fade away. It's not here for the long term. Although maybe in the follow-up questions we'll answer some shifts, but generally speaking, we're seeing good transactions coming up. And speaking of banks, with interest rates being very low, it's also attractive. The total returns of the investments in real estate is really attractive, which keeps people like us who constantly monitor the markets looking for such deals and opportunities that are coming up.
I think that's the important word, looking for these opportunities and keeping an eye for that. Back to you, Abu Talal. Have you noticed any changes in investors' attitudes or behaviors over the year?
Well, I'm going to tell you something. When I came in Kuwait in 1982, in a month or two, the crash of Souq al-Manakh came in, and for years after that, there was nothing to do in the market. Stocks that there were like 20 fills, 25 fills, and nobody wanted to do anything at that time. And so when we wanted to get out of this and establish the first asset management company, it was by default, we had to go outside because of the international markets. There were, there were more variety, there were more products, and the people were scared in Kuwait. So it took us really like good effort to stimulate the demand, and we managed to get 500-600 million at that time. Within, by like 3 years, 1985, when we started the funds. I can tell you, since then, people go through cycles. I call it a shock cycle. And after the major events. And the shock cycle depends on, how the duration depends on how long or how bad the event and how much money they lost. So, they tend to start first to be risk averse. We don't want any risk. We want investment. We want, fixed income. We want, real estate, sukuk, whatever. And then human beings, they have short memories. So with time, even like if you tell them real estate, they'll say, we don't want development. We want yield. But with time, they forget and they start to come back to, to equities. First they go to blue chips. And then they see they don't want to miss the opportunity, or the market goes up. So they go back to the market, the stock market, and until the next crash, or until the next what happened, and they go through the same cycle. What I would like to add here is that in the last 8 or 10 years, I have noticed a new breed or a new class or a new sector of the market, which is the young entrepreneur, people in Kuwait. And these are people who younger, they're very tech savvy. They are very do-it-yourself. They've made money in their markets and in their businesses, and so they have a tendency to be early investors than our generations. But because they lack the investment knowledge, and they lack, they tend to focus on, like, for example, low fees, ETFs, and stuff like that. But they are a good market. They are a sector, and we are actually working on catering to them. Unfortunately, I don't know, I don't have data on how they reacted to, the crisis. But they are a good portion of the market, and they are wealthy, and you can educate them and gain them. But I think we need to study further to get maybe they are the same shock cycle, only with less duration.
What about you, Rob? Have you noticed any differences?
To be honest, not really a difference in behavior. And I think one can describe investor behavior in two words: fear and greed. That's what drives the market, and that's what drives the cycles, if you want, within the market. And the fear of missing out, FOMO, we've heard a lot about that recently. It's that fear of missing out that drives the markets higher. Investors get in, momentum builds up, and you have this market becoming increasingly expensive, but investors still want to take exposure because they take the view that it's going to go higher and higher. And then on the other side of that, you have, and that's actually greed, shall we say. So it's the fear of missing out, which equals greed. And then on the other side of that, you have the fear at market bottoms, because investors, like, for example, back in 2008, they get shell-shocked, and you have periods of capitulation where they simply have margin calls and they need to get out of the market. And then I think it is worthwhile highlighting, as Boutalal was indicating, there is a new breed of speculator out in the market. And we saw that particularly just a couple of months back when the stimulus checks were given to unemployed individuals and others. And a large part of that actually went into the market, particularly through brokers like Robinhood that were buying call options and so forth. And we actually found these investors buying into companies like Hertz, which at the time was bankrupt. So it had already been declared bankrupt, and these investors were piling into that. And that's a very good example of the level of speculation in the market, which is this greed factor. But just to highlight again, markets always move in cycles, so we should be prepared for that.
If I may add a point.
Go ahead, Boutalal.
Like, throughout the years, after the crash happens or after the meltdown, the first thing is that they become risk averse and they don't want equities, where actually that's the best time to invest in equities because they're already taken the hit. And that's, I think, the process that Rob was saying, that you have to be, invested only, and that would have saved you. They usually buy at the top and sell at the bottom.
Can I add a little bit onto that? Actually, I was an analyst with JP Morgan, and I was covering the Russian markets. And I went out to Moscow a couple of months after the crash. So stocks were basically down 85, 90%. And the funny thing is, none of the portfolio managers came to have the meetings with the companies. The prior year they were overweight, but they'd been burnt and they didn't go back. So as an analyst team, we went out there and we were advocating to buy Russia at the time. Fantastic value. Obviously, you can make multiples of the initial investment. And that's exactly what you've got to do. You've got to buy when things are cheap, when there's blood on the street, as Buffett says.
Mentioning turbulence and sell-off, and could you, Rob, touch a little bit on the recent market sell-off that happened here in September, and what's the outlook out of that?
Sure. I mean, the markets rallied very strongly all the way through to September. So if you look at the S&P 500, for example, it had pretty much an all-time high at 3,600 back around the beginning of September, and then it sold off around 9% and has subsequently rebounded. And there's no particular one reason for that. There was concern around the fact that stimulus would be postponed, and indeed it was, but now there's talk of the stimulus being done this week or potentially just after the elections. And then I think also simply the market became a little bit frothy, and there was a lot of speculation in the market, and there was a degree of profit taking. So that's a normal part of the cycle. It wasn't anything to worry about in particular in terms of volatility and so forth, just a regular part of the cycle.
Thank you, Rob. Moving back to you, Dakhil, would you consider 2020 to be a good vintage year for venture capital? And how has been the activity so far in that realm?
Well, short answer, yes and no. And here is why. Usually during crisis times, you get better valuations when you start your investment. And founders, entrepreneurs are being more reasonable these days with their valuations. That said, in the same time, this year, even with COVID, we've seen a tremendous amount of pile up in cash waiting to jump into this sector. For example, globally, there are 24 mega funds. Mega funds is more than 500 million in capital. 24 mega funds that were established this year, even during the crisis. So you will find so much dry powder to chase so few deals. So you could imagine how that would affect the valuations at the same time. So it's a balance between the two. So speaking of the global markets, the activity, even before COVID, we're seeing there's a shift from the number of deals that are happening from later stage private equity to early stage private venture capital investments. I guess the reason behind this is the total return, especially that investors are somehow now are okay with holding their investments for a longer period because they know that they're going to reap the benefits at the end at 7 or 10 years. So globally, we're seeing lots of capital piling up, and we see the mega funds chasing these few deals and going for the earlier stage investments. Similarly, Mina, back in our first seminar in January, we said that we're expecting to reach $1 billion investment in VC in the region. Believe it or not, with the pandemic, the first half we did $660 million worth of transactions in the region, and there is about 500 million on the sidelines. So our expectation still remains that we might reach the billion or just a bit shy of that. What's interesting is that the classification of the venture capital that investors are seeking today. For the first time, we see that fintech beats e-commerce, which is something that we in Rasameel really have a high expectation of, because we believe that the financial services industries will be disrupted, and fintech is taking much room and is being allowed and regulated in the region. So we expect more and more capital to chase fintech, and there are so few people who understand how to really position themselves to come and compete against regular banks and financial institutions. So that's a really fascinating turnaround that we've seen this year. Also, UAE keeps beating the number of transactions that happen. 60% of all transactions in MENA are done in the UAE. Second comes Egypt. And obviously, Saudi Arabia is the fastest growing. So that's a market that's really going to pick up over the years when the economy is opening up. I wish I could say the same about Kuwait. Unfortunately, Kuwait represents less than 1% of the total investment that's happening around us, for obvious reasons that we see around it. Maybe because of the rescue packages that we're doing for SMEs or the lack thereof. So I really hope that with the next parliament, things get better for us, Kuwait, and we see ourselves on the map. So just wrapping things up, VC has still significant activity. Hopefully we reach $1 billion by our next webinar. We'll give you an update on that.
Staying with you, Abdullah, you've mentioned fintech, but what about other sectors that you could see opportunities and possibilities for venture capital investments?
See, we are pro digital transformation. Every business today, whether they like it or not, is a digital business, or they have to expire and die. So these companies who invent themselves how they can better serve the customer, the consumer, and how they can eliminate the middleman and make their supply chain more efficient. Even e-commerce, it's the first leader in terms of investment volumes since the beginning of the flow of capital behind VC. We still see innovation coming up. Every once in a while, we come across a company that revolutionizes e-commerce. So yes, we like fintech. Definitely, we're bullish about fintech. EdTech, education, with Corona, what's happening? All our kids are homeschooling, and we see the benefit. And we see, it was a test, but now we are living it. Health tech is something that we believe is very is going to pick up massively. See, the good thing about COVID, it brought 7 years ahead today. So whatever we were speculating will happen is really happening, and we're living it. And that's what's driving more and more capital to invest in this sector, because we believe that there are so many disruption opportunities is going to happen. So يعني to wrap it up, fintech, edtech, and healthcare, plus any digital transformation initiative that is significantly changing the way people do business.
And you're seeing opportunities in these sectors. You've been active in these sectors.
We are actually, as you are well aware, we have been, for the past year, we've been active in investing actually in a couple of these investments, and we are hoping to even grow our portfolio in that sector and reap the benefits.
Thank you, Dakhil. Back to you, Rob. It's very clear recently that a lot of the asset classes are being impacted by the inflationary and deflationary forces. How do you see this panning out going forward, and where do you see the opportunities that could arise from that?
Thank you, Ali, for the question. And I think it's worthwhile just to step back a little bit here and look at the crisis. The headline of our webinar is the fact that an opportunity exists within the crisis. And the crisis at the current point in time is COVID, right? And we highlighted back in, I think it was April, when we had our first webinar, the fact or the likelihood that there would be a second wave. And indeed, hopefully you can see the chart here, but the daily new cases, and I've used the UK as an example, but it's really across Europe. The daily new cases in many markets in the Northern Hemisphere have increased dramatically. So this is very much a second wave. And this is impacting a large number of the economies. The UK has gone into partial lockdown, Ireland as well, parts of Europe. The US is now talking about restricting groups and so forth. So that's the bad news. COVID has not disappeared, and we still have time to wait before a vaccine arrives. The good news, though, is highlighted in the chart on the right-hand side, excuse me, which really highlights the number of deaths. And you can see there that the number of deaths is still actually very low. So that although our fear is that it will increase over time, we're actually quite confident that the number of deaths is not going to spike significantly higher. And that's driven primarily by the fact that COVID is now much better understood than it was back in the March period, when it was a new disease and people didn't know and the doctors didn't know how to treat it. Now it's far better understood. The drug protocols are now working. Ivermectin has been proven to be successful at curing patients. Regeneron, which is what Trump used, which is part owned by Sanofi, also has proven to work. And then basic vitamins like vitamin D, C, and zinc are also proving effective. So I guess what I want to highlight here is that we have potentially an economic crisis driven by COVID and the lockdowns, but hopefully the health crisis will not be as bad as we were initially expecting. Okay, so what does that mean? What is the issue here? What is the crisis? The crisis is going to drive what we call deflation. And you can see here that when you have high levels of unemployment, which we do in many parts of the world, including the US, which is what this chart relates to, normally CPI comes off as well. CPI declines. And we anticipate that as we move through the latter half of 2020 and potentially the early part of 21, CPI will probably go negative. So there'll be a period of deflation. Deflation is very positive for bonds, and it can be supported to equities, but it depends on how these, what sort of stimulus is pumped into the market to sustain the current equity markets. The point I'm making here, though, is you've got these forces of deflation, and we take the view that the Fed and the government is going to do everything in their power to now drive higher levels of inflation. So I highlight a couple of charts here just to highlight that point. The part on the right is actually quite useful. It highlights personal income, disposable personal income in the US. And you can see there was a massive jump back in April, and that was around 15%. So even though we were in the midst of recession in the US, due to the fiscal spend and so forth, personal income actually rose by around 17%. Likewise, if you look at commercial bank credit, that has actually expanded massively as well. So there's a lot of money flowing from the fiscal and also from the commercial banks. We all know that the Federal Reserve and other central banks have been incredibly aggressive in this market and have added something like $3.5 trillion onto their individual balance sheets. So if you take the ECB, the Bank of Japan, and the Federal Reserve, in total, in aggregate, they've added about $10 trillion worth of quantitative easing. These are huge numbers. And indeed, this is actually quite an interesting chart. It highlights the central banks relative to GDP. And the yellow line is the Swiss National Bank, which has a ratio there of about 142%. And basically, the Swiss National Bank, to try and keep the Swiss franc low, has been printing an enormous amount of money. And they're one of the biggest buyers now of equities in the US. So we think this is all very much going to feed into the markets. It's going to support prices and also precious metals. And then another point to highlight here is the fact that the real yield currently is negative. It's negative by around 60 bips. We anticipate that the real yields are going to decline even further, something like we saw in the 70s, whereby inflation was allowed to run higher, but nominal yields were kept relatively low. So the real yield will effectively go potentially to -2, -3, -4%. So what does this all mean? Basically, we take the view that on the short term, the environment should be quite good for bonds. But on the longer term, with inflation, the environment will be very negative for bonds. Likewise, as inflation rises, that will probably be supportive for equities, which is obviously a positive. But as it gets above 4 to 5%, we anticipate that certain pockets of the equity markets will do very well. Other pockets like growth won't do so well. So we would favor companies that have a high replacement value. We favor those companies in the commodity space. We favor, for example, precious metals and the miners related to that. And also, actually, we think Bitcoin as a fiat currency replacement should do quite well in this environment as well. So a couple of winners and losers out of this crisis situation.
Thank you, Rob. Could you maybe diverge a little bit on the within the equity part, which sectors within the equity part that you see possibilities or opportunities on the longer term?
I'll just pop back to my slide here, and it shows the gold versus fiat currency. I think just to pick up on the point that Dakhil raised, and I'll leave it on the slide, but I'll talk to the points that Dakhil raised in terms of areas of the market that are going to do incredibly well. We like disruptive technologies. So Dakhil was talking about e-commerce and so forth, and this move away from bricks and mortar, and we love that space. So within our portfolios, we are very much overweight the e-commerce players, not so much the e-commerce in the developed markets, but rather e-commerce in China. So that was driven not just by COVID, for example, but it was driven more importantly by the opportunity and the value being offered by these companies in the Chinese market. Second area that we really like is online gaming. So we've been overweight online gaming. We added to the space back, I think, in February period, just before COVID hit, and we've been sort of adjusting our positions recently, but we like that space as well as people stay at home. So we think there are good opportunities in that area. And as Dakhil was highlighting, basically we've had 5 or 10 years worth of future technology and change pulled back to impact us over the next 6 to 12 months. So we've seen some of these companies that will benefit from these disruptive technologies gain massively over the short term. The big area of upside for us, however, is actually gold, silver, the precious metals miners. And I just want to highlight this real quick. The chart in front of you, it shows gold prices across multiple currencies. And you can see pretty much across the board, there's been currency debasement, and gold prices all has significantly higher to go. And in terms of how high can, this is a chart which shows the gold versus the S&P 500 ratio. And you can see that right now, we think that gold is relatively cheap to the S&P, and it can effectively move multiples from where we are at the current point. So we're very positive on that particular area.
Thank you, Rob. Back to you, Dakhil. Are you seeing any paradigm shifts within the real estate sectors? Are we seeing any themes developing that could affect the long-term investment decision-making?
Well, yes, the paradigm shifts, some of them are related to COVID, and some are accelerated by COVID, and some of them are happening for the past couple of years. So I'll run through the sectors and then give you our views. And it's been, it haven't changed much since last year, but there are some updates, obviously. So if I were to talk about the office sector, for example, what COVID has taught us today, that working from home is really efficient. So we would expect that some occupiers would require less space and rely somehow on remote workers. So that would put downward pressure on renters. But that doesn't mean that office will disappear. So the office will always be there, location. So if it's in a good location, obviously that's something you want to be in. But if you want to buy something, either you buy a long-term lease with a very strong tenant, or something with multi-let with more flexibility that allows you to mobilize and make changes as this paradigm keeps shifting. Residential, I guess, there's one of the questions that was asked here. And what happens if renters don't pay rent? What happens? Well, actually, residential is one of the best performers during the year because of the stimulus and people having cash, disposable cash in their hands to pay rents and pay whatever. But this is it's all subject to this unemployment and the situation, how long it's going to be, and we don't know how long we're going to be in that situation. So residential is always a resilient sector. Obviously, you want to be where the job market is. You want to be where there is a balance between life and work. So that's what we see in the residential. In logistics, with the rise of e-commerce, we see that the last mile logistics is still very much in high in demand. The yield compressions are still there. Occupiers are looking for such buildings. So that's a sector we like. And this is a long-term trend that we're seeing. And obviously, with the rise of this sector, you see, on the contrary, retail is being very much damaged by the brick and mortar retail, damaged by e-commerce. However, there are some pockets of opportunity. So if you want to say where is the opportunity, obviously you have to look where everybody is running from. So if everybody is running away from retail, you ought to stay there and pay attention what's happening and what are the dynamics in the market. Again, real estate is a very local game. So part of retail, supermarkets, suburb or residential retail parks are very much high in demand because the demand is still there. Hospitality is very much hit by COVID. The question is it a long-term effect or a short-term effect? Well, actually, it's maybe a mix of two. And it's the most significantly hurt. So you might find if there's an investor with so much guts, they might find opportunities there to invest their money. But also we're seeing a shift in trends in travel. People are looking for more budget stuff, something more convenient in cities with lots of connectivity. So this is something we're seeing a trend before COVID and expedited by COVID. And last but not least, the sector that we really love is the alternative space, which is mainly student accommodation and healthcare sector. The demographics and the fundamentals behind these two sectors are very, very strong. The opportunity we see is that with what's happening, of course, COVID affected the senior living and also affected the student housing. However, believe it or not, the largest transaction in student accommodation in history, valued at 4.6 billion, happened during COVID. So that gives you an indication. You always have to look for those anomalies where the fundamental is strong and there is some noise that's happening and shift the valuations and changes the pricing where you can make your investment opportunities. So those are the highlights of the trends that we're seeing. It's been happening for a while, but COVID again expedited things and made them more obvious to us.
Thank you, Abdullah. I want to go back to you, Rob, and I want to ask a question. Dare I ask, how big is the opportunity that we're talking about?
Well, I think the slide that I can put up here highlights the opportunity very well. So, we do like, as Dakhil was alluding to as well, healthcare. We like healthcare as a hedge for COVID, but also there are opportunities to profit within healthcare. It's a relatively cheap sector, and also you get pretty good dividends from there as well, and then e-commerce and gaming and so forth. But as I was saying earlier, I think the real opportunity is in gold and silver and so forth. And the chart highlights it very well here, that if you have a situation where inflation does pick up a little like the 70s, for example, gold has the potential of doubling, if not tripling, from where we are currently. And you can see back in 1980, for example, the ratio of gold to the S&P 500 rose from what it is currently around 0.5 up to around 5.5. So a massive increase.
Thank you, Rob. I would like to end my questions with you, Butalal. Throughout your career, you have been an advocate for the development of local talents in various sectors, but mostly in the global markets. What has been the motivation for that, and how important is it to expand on that?
That's a nice question, but the choice was made for me. As I said, in '82, when we came in, and the market crash was there, market in Kuwait was dead, and we wanted to venture into asset management. We had to go international for two reasons. One is that the Bank of America was, we were with the Bank of America, so that's international is their expertise, and the local market was dead. All the companies, they were suffering, prices were low, cross ownerships, no regulators, no laws, inside information, inside trading. So it was really a decision made for me. But after working there for a few years and realizing how the market, how deep, how big, how varieties, and you have so many instruments, and you have all these great universities providing all these sectors with great talent, and that's and if you want to take investing, or if you want to take managing people or managing wealth of the people, you really have to go international, because for a simple reason, locally you cannot provide them with the asset allocation model with diversification. So you had to go international and provide and learn that. So after, when we moved to global, and in global we really took managing people's money and wealth very seriously. We had to go international, and in that case I actually had to provide a full asset allocation model, a money market fund, equity funds, small cap, large cap, international, fixed income, real estate. So at what time I had about 30, 35 of my team, and it was a pleasure watching them grow over the years, watching them learn, expand their vision, becoming sophisticated, savvy, because of the meetings, because of the international people they meet, and they go out then the business trip, the conferences, and you really notice that they've really grown, and they've become just like any international employees. And when the time came in for these people to leave, they were all snatched by international houses. I can mention to you, I had Callion Bank, I had JP Morgan, we had Dresdner Bank, Alborn, and Mount Bank. They were all taken, some of the team that we had, because they were just like a commodity, the commodity. They were up in the standard. And my advice is to the people who really into managing money and into managing portfolios and funds. If you feel that you have energy and you have knowledge and you feel that you have plateaued, it's probably because you are only covering the local market. There's nothing, there's no competition makes you excel. Where if you go to the international market and you meet the way where the profession was built, and you meet the managers, and you meet the difference of products and difference of strategies and managers, I think you will learn a thing every day and for the rest of your life. And also, if you are a manager international, you can always bring that knowledge and manage locally, but you cannot do it vice versa. So the reason why it's there, it's because of you can expand your knowledge. There is thousands of width and depth in the markets, and that's my advice to my my friends and colleagues.
Thank you very much, Talal. This is extremely honoring to be as part of this group. That is the end of my questions. And now I would like to take some of the questions posted by our dear guests. So the first question goes to Abdullah. Why Kuwait is only 1% of venture capital? And what's the reason behind that?
Well, my interpretation for this is maybe two things. One is that the size of the investment itself is huge compared to Kuwait, so that's why it shows minimal. Second, not all, but a lot of companies you see that are incorporated in Kuwait migrate or يهاجرون, they go to do their setup somewhere else, such as Abu Dhabi, ADGM, Dubai, Bahrain, and they get funded there, and that is considered to be fundraising and elsewhere. Although those ideas are born from Kuwait. Kuwaitis, alhamdulillah, are known for establishing good companies. But unfortunately, the amount of investments are not yet at the level that we would like to see.
There's another question. I think this one is for you, Rob. Given that we've never seen a pandemic like that, at least in our lifetimes, have you changed your investment parameters to be proactive with the movements of the pandemic, or did you stick to your strategy before the breakout?
No, we've stuck to our strategy, right? We are valuation orientated managers. So we will look at the underlying fundamentals of the various companies that we look at and look at price earnings, EV/EBITDA, et cetera, very much focused on valuations. But clearly when COVID was appearing back in January in China, as I was highlighting earlier, we did start to reduce our exposure. Basically, we took the view that COVID would have an impact on the underlying economy. There would be lockdowns potentially, and that would impact equities. So we reduced our exposure, not a huge amount, unfortunately. I wish I had done more. And then we added back exposure through March, April period. And the thing is with the pandemic, actually, COVID is new for us, but we have seen this sort of thing before. 1918 Spanish flu, for example, and in the first webinar that we did, we highlighted the wave, the first and the second waves and so forth. So we look around the example that we've seen previously. And, on the back of what we expected to fall out in terms of lockdowns, we focus more e-commerce plays, we focus more on online gaming, and we reduced our exposure to typical brick and mortar. And obviously, we wish we'd done a little bit more in terms of cutting exposure, and we wish we'd done a little bit more in terms of adding exposure. But it's difficult to figure out what the markets are going to be doing in terms of the Fed impact and what the ECB is going to do, etc. It's quite a complex situation, but I think we managed it relatively well.
A question here to Talal. Could you comment on the importance of infrastructure investment, particularly here in Kuwait, with the listing of companies like Shimal al-Zor and Ula Power and Water? How important is that?
Well, I mean, it's very, very important. I remember, and if you look at the stock markets in Kuwait, there are a lot of very, very, successful and attractive and important companies. They're not listed there. Where if you look at in the Gulf, they are represented there more often. And I think, looking at Kuwait, probably we need a huge amount of infrastructure, but unfortunately these are not these are all government. It would be great if you find an international fund that will do deals in you, but unfortunately this all will have to be done by the government. So it is very important. It gives variety to sectors, and it gives the people opportunity to broaden their investments.
This question to you, Rob. How is active management, like investing through an investment company, better than passive management, like simply following an index by yourself?
Well, I think the numbers sort of highlight that. So if you look at the various strategies we manage, the strategies have generally outperformed their benchmark. So we've been fairly fortunate in that as active managers, we have outperformed. But the question is quite valid. There are a vast number of managers that underperform, and indeed, we may go through a cycle whereby we're buying value, for example, which is out of favor, and we could lag the market for some period of time as well. Here's what I would say, though. Right now, I would be moving away from passive management towards active management, like what we practice at Rasameel. Very simple. There's been a massive amount of money that is piled into passive management. And all they do is they receive the inflows, and they go out and they basically add to the equities that they currently have exposure to. So for example, an S&P 500 ETF, the money comes in and the ETF provider buys the index and buys the companies within the index. What does that mean? It basically means that there's no price discovery in the market anymore. You're buying Apple regardless of what the earnings are. You're buying Netflix regardless of what the earnings are. You're simply pushing the market higher and higher, driven by these inflows, but there is absolutely no price discovery. What we're trying to do is look for pockets of the market which are not necessarily within the ETFs, not within the index, and that's where we think there is excellent opportunity. So one of the names that we like, for example, it's a large China e-commerce play. It's not in the index like the S&P. And it's done incredibly well for us. And these are the sort of names that we're looking at rather than simply buying the various index names. And one thing I would like to say here is, if there is a market sell-off, like we saw, for example, back in the March period, the first thing that investors sell is the ETF, because they anticipate, or they have this expectation that there's a lot of liquidity within the ETF. The reality is there's not that much liquidity in the ETF. The liquidity lies with the individual securities. So you may think you've got a lot of liquidity within the ETF, but if everybody sells at the same time, the holdings within that ETF are going to decline very, very rapidly. So one has to tread quite carefully within the current market.
A question to you, Abdullah. How is the impact of Brexit on the real estate sector in the UK?
Well, Brexit isn't something new anymore. So I would believe that whatever effect is going to happen is already discounted in the prices, and the transactions that have happened and are yet about to happen already take into account Brexit. At the same time, the UK is an international country. London precisely is an international city. So if the effect will happen, yes, it might affect some pockets in London and the city. However, the UK in general would survive this. The effect, I would say, is not that much.
Another question to you, Rob. With the current deficit within the US budget, is the US in a situation where they could go for further fiscal spending?
Yeah, they can. I think the reality now is that the central banks are now pretty much controlled by the governments. We've seen that pretty much be the case in the last couple of months. So I don't think, and COVID is actually a great excuse now for the central banks to undertake a huge amount of quantitative easing and buy bonds being issued by the government. And if you consider the fact that in Japan, the level of debt to GDP, government debt to GDP, is now around 250%, the US is down to around 110 and increasing rapidly. But I think President Trump, and Biden for that matter, if he comes into power, will take the view that there's plenty of room to increase government debt, particularly given the fact that we're in the midst of a recession, particularly the fact that we have COVID. So I think deficits don't worry the government officials at all. I think you can expect that most countries are going to have huge deficits, and that their central banks are going to be buying the bonds to make that happen. So in effect, what you have is a degree of money printing, and deficits will increase rapidly, and that will feed into the underlying market. But we think in particular the precious metals, because effectively what you are doing over time is debasing the currency. And over time, as well as we think, that will drive higher levels of inflation. And I know I'm talking a little too long here, but the next step of fiscal spend is not just to invest in industry and new road building and so forth, but actually to deposit money directly from the government directly into individuals' bank accounts. And we saw a little bit of that with the stimulus checks and the unemployment benefits and so forth. And I think we're going to see more of that over the next year or two.
Thank you, Rob. To Talal, now we've mentioned here fiscal spending and stimulus packages. Do you think in Kuwait we need that as well?
You mean in the stock market? I'm actually,
the general economy. The general economy.
The general economy, of course. The general economy is that you have to protect those SMEs. The new entrepreneurs that we said. Yes, you have to help them. And I don't know, for one reason or another, the law that was presented was, I don't know. They've put in too many things to make the parliament rejected it. And as a result, I think those entrepreneurs, they're really suffering. So to tell you the truth, when the crisis happened and a government comes in because of the prices are low and comes in and buys, those, and after 4 or 5 years, everybody will make money. But to come, now and just drop money on the stock market, I don't believe that's needed. There is a lot of liquidity coming in the market. What I believe in is that, what the money follows the earnings, and the money follows the companies, the good companies. And the more we have good companies, and believe me, you will have liquidity. If you recall, when we did, in the 2-3 deals that happened in the last few years, Mizan was covered by, I don't know how many times, the Shamal Azur and the stock market. So bring me a good company, bring me a good idea, with good management. There's plenty of liquidity to go there. You don't need a stimulus. What you need stimulus for is those, I think the people that really got hurt from COVID. Those are the people who need the stimulus.
A question here. The Kuwaiti economy is hinging on the oil sector and the oil prices in general. What's the outlook on the short to medium term? Are we seeing any upside, any potential recovery in the oil sector that could have a positive impact on the Kuwaiti economy and the budget deficit?
Is that one for me or for Butala?
Yeah, you can take that, Rob.
All right. So we're not particularly positive on the oil price at this point in time, primarily, I guess, driven by 2 factors. Number one, we're still in the midst of a pretty severe slowdown. Yes, Q3 will be better than Q2, but if you look at the economy generally, it's pretty slow relative to where we were a year ago. So that's obviously going to impact oil demand, number one. A very good example is obviously people are flying less, right? So the transport sector will demand less oil. And number two, we're going to get a shift towards greener fuels, such as gas, for example, and potentially other EV, which is going to be driven by hydro and by nuclear and so forth. So over time, there's going to be less demand for fuel relative to what we've seen per capita historically. But I do think that oil prices will probably slowly increase from where we are currently, probably hit around $60. And then you should anticipate that the shale producers in the US will come back on stream. So we've probably got a top line figure of around $60, which is still relatively low to some of the peaks that we've seen historically. One other quick one.
Yes.
So the team, we're going to organize a small webinar, probably first or second week of November. And on that will be Abdul Mohsin, who covers GCC for Rasameel, and Abdullah, who covers oil within the group. So the two of them will be having a face-to-face, like a fire conversation. We won't be inviting attendees for that, but we will record that and we'll send it out to anybody that would like to have a look. And that will be on the internet as well and on the website.
That's very nice. That will have a better coverage on the oil sector and the local and GCC market. I think that covers all the questions we have. So that concludes our webinar. I would like to thank our dear guests and our speakers, Mr. Robert Aspin, Mr. Al-Dakhil, and our special speaker, Mr. Al-Gharaballi. It's been an enjoyable time to spend it with you guys and with our dear guests. Thank you for giving us your time.
Thank you,
Bilal.
Thank you, everybody, for joining. Thank you.
In person.
And thank you, everybody. Hope we've answered some of your questions.
I'm sure I think you covered a good chunk there. And we hope to see you soon again in person after the end of this period that we're going through. Stay safe, and I wish you a very pleasant evening.
Thank you.
Thank you.